Okay. So my name is Connor O'Brien, and I'm the managing director for PersonaFi. PersonaFi is the company, the investment company behind the Facebook group. We're coming out with an app, all of the above. Chris, I don't know if that's you that's transmitting or somebody else, but we'll let it go. So we've got a couple things in the works. Obviously, we have these classes to help you guys learn more about trading options. You see the newsletter, you see some of the gains that Ryan gets. Myself, I post a lot. Ken posts his. And people just want to learn how we're doing that. So we're going to start having these classes that can show you and hopefully do some about how we get that done. So I'll share links. What I'm asking everybody to do, since we're doing this free of charge, we're not going to charge you for classes. I would like you to go to our YouTube and just subscribe to it. So we put all the classes on there for everybody to go see later. So I would greatly appreciate if you go to the YouTube and like it and subscribe. And then also, if you're not signed up for the newsletter, that's where all the big money makers are, the newsletter. Okay, Ryan's got his own section and Ryan is crushing it. He always crushes it. He's like a wizard. So that's a good one to be. There's a team of us that write the newsletter, and a lot of it comes from the man himself, Ken Musu, who started this whole thing. So first and foremost, does anybody have any like questions, like real basic entries questions? Do people need need like options explained? What we're really focusing on right now is just basic call options. Okay, we're not doing any puts, we're not doing straddles, we're not doing anything like that, because the one thing that you need to understand is a call option. It's the easiest to do. You think a stock is going to go up, you buy a call option. Okay, and I will let Mr. Haven take it over after this. People aren't really saying anything. Yeah, so newsletter is sent out 6 p.m. Mountain Standard Time on Sundays. It will only be sent out once. And then also we do a midweek update that happens Wednesday nights, just to kind of make edits to what we said on Sunday. We do send out emergency updates if something changes. We might also institute text message emergency alerts for newsletter subscribers. We would require you to provide us your cell phone number, but we're not going to share it with anybody. That's something that might be in the works. But Wednesday nights, the halftime show is what we call it. That's just going to tell you what has changed from Monday to Wednesday, and then give you some more plays to make for Wednesday through Friday. So you get 2 of those a week, one on Sunday, one on Wednesday, $9.99 a month or $100 a year. So it saves you 2 months. We have not sent out the update for tonight. Wednesday nights are late. The guy who makes our newsletters look pretty does not get off work till late. So there's a lot of effort. There's like a team of like 12 people that put that together. So thank everyone for their effort that goes into that. So let me see here. I'm looking for just call option executions. So we are using tonight, we pulled up Webull because a lot of you guys know Webull. So Chris is going to kind of show that. I believe it's much easier on your phone. We might post some videos about doing it on your phone soon. That's probably something that we're going to do just so you guys have it. Let me look at questions here. I want to know how you know when to enter a call option. Oh geez. I got to figure out how to mute these people. I had it set up, but where did that go? Executions would be great. How to buy and how to watch. So when to enter a call option. So Chris, you can take off here.
Okay, and you can hear me correctly?
Yes.
Okay, so let me actually write the question. So what is the question?
So the question is know when to enter a call option and the execution, basically.
So how to buy it?
Yeah, and how to know when to buy it. They want to know the execution of a call option. So if the stock is low,
And what strike price?
Sure.
Okay. Let me change that so it's nice and... Okay, so
other
the
kind of
qu-
similar things that people ask is like when to enter and exit call options. Okay.
okay. So the question for this particular, so who is this person that asked?
There's like 5 of them rolled
Oh,
into
okay.
one.
Okay. All right. So the question was how to know when to buy a call option and what strike price to choose. Okay. So again, if you've watched the previous videos, a call is the right to buy a stock at a certain price at a certain date, but in quantities of 100. So when we talk about a call option, it's a contract for 100 stock shares. Okay. And so we're just doing with calls. So calls just means the right to buy. So on Webull, I just chose AT&T. It's something that doesn't really move very much, but let's just say we know AT&T right now is at, and I'm still trying to get this to do that. Okay, so we know AT&T is at $28.51, and it's the middle of the week. It's Monday. I'm sorry, Wednesday. So I know, and I'm making this up. So I know AT&T. It's a strong company. It provides dividends. You know, they claim that they're the fastest network. You know, just something. But I may think, you know what, AT&T. They've been talking in the news about how they're making a lot of technology for 6G. Let's just say 6G. So if I knew that, or I have an inkling that when they release some news, or just in general, maybe their earnings are coming up, and I think that they're gonna have a strong, solid profit, or maybe I want to think long term, but I don't want to invest all the money into AT&T. So we have advanced. These are more intermediate financial products, and the options, which are calls. So let's just say, going back to how to know when to buy. So the first thing that you have to look for is you want to know, are you going short term on news? Are you going long term just to hold and have an increase, or just to hold for long term? Going to long term. So basically 9 months to 2 years.
So basically, in layman's terms, you're
Yeah.
going to buy a call option if you think the stock price is going to go up. Okay. So
Right.
if you think AT&T is about to crush and just go up, what's that, 28.51, you think it's going to hit 30 or 35 within the next few weeks, then that's when you buy a call option. Okay.
Right.
And Chris will get into, I see people asking, how do you pick strike prices? How do you pick that?
Okay. So yeah, so there are a couple. So the first thing, if I were to look at a call option, and if I want to figure out, okay, am I going short term or long term? And I'm going, let's just say we're going to go on news. So if I'm going to go on news, it really depends on, and that's where I have to talk about the Greeks and explain that. But let's just talk about going a month out. So if it's considered February 3rd, so I'm just going to go a month out, and I'm going to click on, so just so everyone knows, with call options, there are monthlies which expire on the 3rd week of the calendar month. But then there are weeklies which are introduced on Thursdays the prior week, and those are just to literally day trade. But let's just do the basic. So I'm gonna click March. So it says 19 March 21. So this means on March 19th. So on March 19th, 2021, I have the right to buy 100 stocks of AT&T, and then I just have 5 strike prices. Okay. Or I'm sorry, I have 10 strike prices. So let me just define what those are first. So you're going to have the date, which is going to be the way Webull is different. So I usually show Schwab, but you're going to do the date. So I'm choosing March 19th, 2021. Then you have what's called your strike price. So that is the right to buy at this price. And so I'm just going to show what's called ITM, which is called in the money. or no, I'll do ATM, at the money. So I'll give you some definitions too. So you have ITM, in the money, past strike price. ATM, at the money, same as the strike price. Or OTM, out the money. So it's not yet hit the price, just to make it simple. So what do I mean by that? Okay. So if something is considered in the money, I'm going to look at the price. So that's $28.51. So when I look at my strikes, anything that is past $21.51, that would be considered my in the money. And so I will highlight that with yellow. So all of these on your Webull, 24, 25, 26, 27, 28, those are what's called in the money, which means it's past what the actual stock price is. At the money would be $28.51, but since this AT&T does not have a $28.50 or 51 cent, then it's not going to show. Some options won't go in; they'll have 50-cent things, but for this example, let's just keep it simple.
So, and I want to chime in here. So somebody just asked, what happens to in the money calls if no buyer? Okay, so when we talk about options, we've got to dumb it down for everybody. We are just physically buying and selling the contract. We are not going to talk about exercising an option. There's a few times where you would actually exercise the option. So the right to buy the stock, and you would physically have to buy the stock at the strike price. We're not worrying about that right now. What we're worried about is physically buying the contract for money. It makes a gain and you sell it. You just click sell on Webull. So don't worry about in the money, out the money. Just like worry about that for how much you want to make off of the contract. Don't worry about if somebody's actually going to exercise you or you exercise it at this point. Okay.
Okay. And so out the money. So that's any money that's not yet hit the price. So again, we go back. What's the price? $28.51. So all of these are considered your out the money, because is 28 greater than 29? No, but 28 is 27, 26, 25, 24, blah, 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 blah. Okay. So I'm going out, I'm basing it on news. So generally with news, you want to go maybe a month or two out, depending on how long you hold it. So just so you know, when you're dealing with an option with the definition, so again, it's a contract with the right to buy at it. So I should probably type that. I'm going as fast as I can, guys. So
you're doing great, Chris.
Call option. Dang it. Call. Wait, you guys can see all the drawings and stuff, right?
We can
Just
see it,
sure.
but that's what you're typing right now is white.
Okay, call option. The right to buy at a certain price at a certain date. Okay, I'm a horrible speller. Text. Come on. Okay. The right to buy at a certain price. Okay, all right, at a certain date. So if I were to say I'm going to buy March 19th, 2021, and I'm going to look at a strike price of 29. So let's use that for our main example. So that means on March 19th, 2021, I'm going to buy a contract. So a contract's not a stock. So when you say I bought an option, you're not trading stocks, you're trading a contract. Options are called contract trades. So I'm going to look at this $29 strike, and I'm going to go over all the different stuff of what I'm seeing here on this. And if I go too fast or too slow, just let me know, and I can explain stuff.
So and briefly in layman's terms, okay, he's picking a March 19th expiration date. So that means he thinks that the stock will go above 29 by March 19th. And the more it goes above that, the sooner the better, the more money you make, because of things that he's about to explain, like Theta Decay and stuff.
So the example is if you're to talk to another person that's in finances, you would say you bought T call. I'm trying to like write it so that way you don't get distracted by the other stuff. So T call, so an AT&T call at 29, and then you just say the date, which would be 3. Dang it. It's hard to do on a mouse, guys, just so you know. Okay, so that's what we're looking at. So now you don't just buy an option and it's for free. You know, you have to pay some money out. Now it's just with the contract, it's the same thing. You know, if you're trying to take advantage of a call option, you have to pay what's called a premium. So a premium is the price that you pay. So let me write the next definition. So premium, price you pay. It's hard to, I need to choose a different color because that just shows up blank for me. Price you pay. So when I look at this, there are a whole different, there's different things that you see. You see theta, gamma, delta, and I added these. Theta, gamma, delta, IMPL vol, that means implied volatility. Open int, that means open interest. Volume, ask, and bid. And Connor, on Webull, how do you switch these? You know?
How to switch what?
Like, how do you, because again, you asked me to use Webull, not Schwab. How do I move this stuff like around?
I don't know if you can.
Oh, okay. So let's just go. Let's start from bid, and we'll go backwards because these are the easiest to look at, and then it gets more advanced from there.
So, real quick, answering your question, Walter, what determines if you buy a contract in the money or out of the money? That's up to you. So if you think something's going to move really far, then you buy something out of the money because you think it's going to get there, and it's much cheaper than buying something that's in the money, because in the money it's probably going to be above that, but you're going to pay way more upfront for it. So we'll get there as well.
So the first thing, so I'm looking at, so the main one I'm looking at is just this 29. So my what I'm doing for this example is I have a feeling AT&T is going to go beyond $29, and I have a feeling it's going to hit that within a month based on the news, or based on just them being a solid company. So what I'm going to look at first is I'm going to look at my bid. Oops, that did not work. So does that do anything when I do Spotlight? Does everyone see that?
It just shows a little red dot, yeah.
Okay, I'll turn that off then. So what I'm going to do then is I'm going to look at my bid. So a bid, that is what people are offering to buy. Think of it like a car auction. You place a bid, or you wave your hand. You know, you're like, oh yeah, you know, do I hear 50? Yes. You know, do I hear 60? You know, yes. So that would be your bid, the bid that you put in. Now your ask is going to be what people are asking for it. So if I had an auction and this person initially wanted $25,000 for a car, their asking price is $25,000. So options are really similar to auctions in regards to the stock market. You know, let's say you have a really good collector's car, and it's like a Porsche 911 1970. I don't even know. But they're gonna ask for a certain amount of money, so that's like their starting price. So if they start at 25,000, that's their ask. But then you can have bids that will outbid it, and then that goes. But so basically the ask, and again we're doing the 29, so it's bidding at 0.71. Well, what does that even mean? Okay, so if I see 0.71, again, these contracts are in for 100 stocks. All the data is just telling you the information per stock. So anything you see on these two things it's going to be times 100. So if I want to buy this call, if I see 0.71, You have to times it 100. So my premium for this contract is going to be $71. So I'm going to pay $71 to buy this contract to buy 100 shares at this date, March 19th, 2021. But then what's the ask? The ask is 73. I'm sorry, 0.73. So when I look at that, so 0.73 times 100, that's $73. Okay, so generally these may not fill, and by filling it may not be purchased right away, because these numbers will, well, with AT&T it goes a little bit slower, but you will see options that will frequently change prices in seconds or even every second. So for what, I don't know why, but Webull doesn't have a mid price, but generally if you do a mid price, it will fill. Let me also just talk about some real quick do nots. Excuse me. Do nots. Sell to open. Okay. Buy at market. These are just, and these, you can do these things, but for new investors or beginner investors or even beginner to intermediate investors, you can do those if you want, but you need to know what the risks are involved. But I'm not even going to cover that at all. What you want to do is you want to set a limit price. Do's. Set limit, or sorry, buy to open, limit order. Now people will say, but you can sell the open, or professor, you can sell the open, you can buy at market, but these are just starting things. Oh, sorry guys. But just for beginning, let's just do it that. So let's just say I'm just going to focus on the bid right now, but I set an order for $71, or you would actually input the cent. So it needs to be 0.71 when you input it. If you put 71, that means you're willing to pay $71 per stock times 100, which would technically be $7,100. It won't fill at that. Don't worry. It'll only automatically fill at your ask price. But just for right now, that's where we're at. Okay. So now it fills. All right. What's going on?
Can you explain buy to open real quick?
So buy to open, when you go to your broker, let's see, how do I even buy an option on this? I have to open an account before. Okay.
Just give us a quick reason why you buy to open.
You buy to open because it's saying you're submitting a bid to buy a contract and open it.
Yeah. So you're not buying to close. So
right.
Limit orders are set. You can, when you're actually on Webull. So this is a lot easier on Webull, the mobile. When you're actually on Webull mobile, it will show, you go over to options, and I'm just going to do it so I can tell you. And it'll ask you market or limit. So if you set a market during the market time, it'll just fill right away. If you set a limit for it to do that, that's how when you buy and sell, you set limit orders, just like a stock. So if you want to buy it or sell it at a certain price, like I know Joshua asked, how do I know what is the best way to set my price to make sure it executes and I don't miss the game? If you have a crystal ball and know the future, sure. But if you're happy with 20% gain, then set your limit 20% higher than what you bought it at. So.
Right. Yeah. We're just talking about we're opening. Okay. So we bought it at $71. Let's see, can I delete this stuff?
Yes.
Okay. So before anything, let's just say we understand what these strikes are. This is the right to buy at whatever these numbers are. The bid is the bid that people are asking to buy it at. The ask is the amount that people want to sell it at. So when you think about buying and selling, it's just like, I always just go to cars because everyone knows cars. There's going to be someone that's selling the car and they're going to ask a certain price. You're going to bid the car, you're going to place a bid, And then, so when you buy something, it's going to then be, a transaction. Someone sells it, you buy it, you now own it. You don't like the car anymore, you're going to sell it. You're going to put an ask price out. Someone's going to bid on it, and it could be, what you ask for. So that would be considered a market price. And then, and then it just keeps on repeating. This is the life of cars. So now let's just talk, let's then go into what volume is. Volume is just kind of the example I said. When there's a transaction that occurred, so when someone sells an option or a call option, one transaction, one volume is going to be when someone sells it and then someone buys it. So it has to be both. So what I'm seeing, this is today. So for the strike of 24, nothing happened. There were no sales, meaning, excuse me, meaning the volume's at zero. Open interest, that's how many people are asking, but right now we're at volume 0. So that means no one was able to sell it today. The 25, volume's 23. That means there were 23 transactions that happened. If the volume is 0, should you just exercise? So real quick for John's question, he was asking if the volume is 0. Could you just exercise to ensure you can profit? So if you exercise the contract, that's a little bit more advanced, and I'll get into that in a little bit. But let's just say that there was just 0, but you do want to sell it. You would then have to sell it at the bid price. And because that's the market maker's rule or role, is to make sure the market's fluid. So if there's still 0 volume, but you want to sell it, then it would just fill in at the bid price, or you can do the mid price. It may be able to fill at that point, because the market maker may say, hey, they're all computers, so it's really hard to determine, who's gonna, if they'll fill it or not. But if you set the limit to $4.60, then that. Brett Barker says, how come the strike price of 24 has no volume? 28 has more volume. Okay, so looking at the $28 one, there's more volume because it's near that price. So generally, like day traders, or maybe even people that see that the call is hitting there, they'll want to maybe sell it because it's considered in the money now. So they'll likely sell it. It just depends on how that is with the trader. So like the volume for here is 253. So that means 253 people, they're like, okay, I want to take a profit. So this was probably some day traders. The reason why these volumes get lower is because they're considered way in the money. So these people will still hold it in hopes of it going further. And I'll go further on into what that does. Okay.
The gray below the ask and the bid, is that the number of contracts that people are selling?
Yeah, that's where. So if I were to look at my 29 example, that means at this price, this ask price, that means 2 people are selling. They're selling 2 contracts. So if you were to buy 2 of them at $73, then it will go to the next ask, which would be $74 or 74 cents, and then it will have a spread of whatever that is. Yeah. This would be what's called a spread, and this on tomorrow. So we're doing more of an advanced one today, and we're doing a more simpler one tomorrow. So I apologize, but so that means currently there's 10 contracts open for them wanting to buy. So someone may have put in a limit for quantity 10, but at 71 cents. But then, the seller point is 0.73 or $73 at 2 contracts. All right.
Yes, it's always for 100. So one options contract gives you the right to buy 100. But again, don't worry about exercising. It's just going to confuse the shit out of you. And if you don't want to be confused, dumb it down for yourself. It's much easier to just say, okay, I'm going to buy this options contract and I'm going to sell it later for more money. That's as simple as it gets. Yep. When you throw in the exercising, everybody's like, okay, that's where in the money and all this kind of stuff comes in. And it's just, that's where break-even points really matter. What matters now is that even something before it hits your break-even point, you can start making money on that. So let's worry about our first.
Yes.
You'll learn as you go. You know, like I want you to get to the point where you can go in and confidently buy a call and sell a call. Once you can do that and you do that a few times over, then you can start to think, okay, I have a long-term leap and all this other stuff, but we're not going to get into that right now. It's just buying and selling contracts. Done.
So now looking at the other stuff, so we talked about volume, we talked about bid ask volume. You have now what's called open interest. So open interest, that means how many people actually have something open for sale or open to buy. So like it's just literally what it is. Open interest. How many people are interested or how many contracts are interested. So when you go closer to in the or at the money, there's going to be more people wanting to either buy or sell because they're thinking, hey, okay, this is hitting that. It could go higher. You know, I want to make some profit or take profit. Or there could be people selling the contract as well.
There's a question in the chat that I want you to look at from iPhone.
It says volume is how many were traded and open interests have not closed yet. Yes, so that's kind of like how many positions are open, whether it's for sale or to buy. So I can look at that data and that can actually help me determine kind of where people are at in regards to that. So if you look at the open interest, it's kind of inverted. Oh wait, I don't even want to talk about puts. Sorry, going off again. Okay, so so when I look, there will likely be less amount of people trying to close their positions when they're in the money, way in. So how do you define way in? I mean, that's up to you. Maybe determine what the stock is trading at. What is it historically trading at? So let's just say AT&T has been at a range of like $26 to $31. If you know, like historically it's never hit below 24 for a long time, then 24 I would just determine, just based on what I said, that would likely want to hold on to it. And then now we have what's called implied volatility, or vol. That means implied volatility. So let me type that. Volatility. Oh, sweet. I got it right. PhD and awesome. Still can't spell. Okay. So this is, where is the draw? Oh, there's the draw. Okay. So implied volatility, it's a really complex equation that is determined, but in layman's terms, like just to get a really good idea, it's basically saying this is the percentage. Oops, I didn't even realize what I did. Sorry, guys. This is just in a real simple term. It's like how much the stock is going to move in the day or in the week, depending on how you look at it. So and now this increases let's just keep it at that. What you want to look at with implied volatility is the higher this number goes, the more of the premium you're going to pay. So when I'm going back to my 29 example, this is at 23.52. That means like this stock isn't going to be moving very much. So it's not going to move very much. So it's not really dangerous. So I guess when we talk about dangerous, we talk about GameStop right now, since everyone knows about GameStop. GameStop went from $25 to $40 to $500 within maybe a month, and then it dropped back down to $90 within a week. So that implied volatility is in the hundreds. It was I think it was at 800 yesterday. So that's how dangerous something can be. So if something's more dangerous, then you're going to want more money, right? I mean, would I want to sell a GameStop option where it could go up, exorbitant amounts of money, and then I lose a lot of money because I'm, if I were to sell something, which it gets a little bit more complex with that. But so the people that are technically that are offering these contracts, they want some protection for themselves, or they want to make sure that they get a lot more money for it, because it wouldn't make sense to sell something that is dangerous for a lower price when it can exceed the price. So that's how that can affect prices for options. So again, the higher the percentage, this is going to be more expensive. So now let's just talk about that right there, and let's just stop. So I'm going to erase this, and I'm going to erase that. I'm going to still keep these definitions. So now I'm going to talk about break-even point. So break-even point is going to be the strike price plus the premium you paid. So basically what that means is how much does this stock need to get by the end of the contract date? So I paid 71 cents. So so T call at 29 3/19 2021. So I'm going to look at the price I paid. So I'll say premium equals 0.71. We're just going to do bid, not make it complicated, which means that's $71. So if I want to calculate my break even, so again, break even point, the strike price plus the premium. So what's the strike price? It's $29. So $29 plus 71 cents, that's going to equal $29.71. So that just means by March 19th, 2021, it needs to hit this price to break even, meaning I paid my premium for it, and this is the strike price of $29. So technically this needs to hit $29.71. Oh, but professor, why how can I make money if I don't think it's going to hit $29.71, but I still want to, why would I choose that stock? Well, it has a month out to go to get to $29.71. So that's where you kind of look at what's called your Greeks. And so I'm just going to talk about two of them, which is going to be delta and theta. So what this means, let me get one, and let me change the color. So these are two definitions. So delta is the change of price of the stock of the option per dollar. Oops. So let's look at the delta. So this delta is 0.4, and again, so when we look at decimals, generally it's always going to be times 100 because we're talking about the stock in times the options contract because it's 100 shares. So if it's 0.4, that means if AT&T is at 28.51, if it goes up another dollar, so let's just make it simple, and let's just make it simple. Let's say it hits to $29. It's going to go up 0.4, which means every dollar AT&T goes up, it's going to now be worth $40 more. So again, delta is the change of price of the option per dollar. So if this is 0.4, and I pay, if I say, or if I bought it at 0.71, so you're going to add 0.4 to the 0.71, and then that will be your new option price. So the example would be.
Yes, can you say that again?
Yeah. So again, delta is the change of price of the option per dollar. So if AT&T hits $29 and the delta is 0.4, and then I know what my purchase price is, so it's 0.71. So premium equals 0.71. So just I'll just forget the one. So 0.4 plus 0.7, so just 4 plus 7. So that's $1.11. So now the 29 will now look, you'll see it shift to 1.11. This may be like 0.113. It just depends. Okay. Now, unfortunately, you have some stuff against you. Everything's looking really, really good, but then again, there are some other underlying forces that are moving against you, and that is what's called theta. And people you'll hear theta decay, but let's just talk about what theta means. So theta equals the change of price of the option per day. So that's why when you see theta is negative. It will always be negative. It will never be positive unless you go back in time. Ha ha ha. But so let's say everything just stays the same. So I'll delete all this. Delete that. So it's like going to math class when you're doing these. So if I say so we're just going to keep the 0.71. So I bought my option for 0.71 or $71. So I'll write $71. And my theta is negative 0.01. So when I do the math, that's 0.70. So if nothing changes, meaning there's just no movement in terms of the stock, this option is now only worth $70. Now, theta will, and I chose a bad example for theta, excuse me. But if I go to, let me just show another one. Let's just do Amazon because this is a lot different. Look at this theta. So, and again, I'm going on just so you can see a different example. This theta is negative 6.34. Again, it's times 100. So I looked at whatever this is to buy Amazon at 3,300, and this is September. So just without looking at any of the stuff, if this is negative 6.34, that means every day it loses $634.
So he asked, when do you apply the Greeks? And the Greeks are applied 24
all the time.
Yeah, it doesn't matter.
It's market open. It will apply the theta, and then again, pre-market opens at 2 or 4 a.m. Eastern time or 2 a.m. my time, which is Arizona or Mountain time. So, but then it's applied at market open. So true market open is 9:30 Eastern time. So if the stock goes up, that could be good for you. So if the stock moved up, let me go back to my example. If the stock moved up, wait, what did I click? Oh, good thing I had these circled. If the stock moved up, let's just say going back at my example, the delta is 0.4. So if AT&T overnight went to 35, I know roughly this is going to go up. So it would be if 29 and we hit 35. So again, it's going back to math. 35 minus 6. Oops, set the answer. 35 minus 29 is 6. 6 times 0.4, so 3.2. So that would be $320. This would go up. That's why people do what's called earnings plays, meaning they're betting that the company will either go up or down, and they're in hopes of it going up or down, but they're still locked in at this price. So when the delta is applied, that's what happens.
So is that making sense? And don't worry.
We're going into some advanced calculations.
Don't worry too much. Okay, so obviously, if you are looking to buy it, once you get a little bit more, and after you buy it, you can start looking at theta, you can start looking at delta and gamma and all that, and always post it in the group or ask in the group. We'll say something. But at the end of the day, we're going to buy a call option on a stock that we think is going to go up, and we're going to sell it when we have a gain. Okay, and everybody's going to ask, well, when do I sell it? We don't know. We can't tell you when to sell it. So like in our newsletter options, we will give you where we would sell it. Like if it breaks past, I think AMD had like a 90 plus this week, but there's a possibility it might not get there. So if you see a gain, what you have to realize is that we all should have plans when you're actually trading. I know Chris and I are both the same way, and Ken is the same way as well. If we see a 20% gain on an options, we're happy with that, because guess what? We're not losing money at that point. Could it hit 100%? Of course, yeah, but it could also drop from 20% back down to losing money real quick. So what you have to decide is what you're happy with. Greedy hands or weak hands, is that what they say, or what is it?
Weak hands or green hands?
Weak hands or green hands. So it's just like, if you're greedy and you want it to go further, there's a bigger chance that your option is going to take a dump the next day. Like you could go where you're up 20%. When market closes, after hours, it plummets. You wake up in the morning when you can first sell it and you're now down 20% where you were above 20%. So we can't tell you when to actually physically sell it.
Yeah, there was a question about if the delta is 0.56. So again, always use your multiplier of 100. So 100 times 0.56, you just carry the decimal 2 places. That's $56. So if your delta goes up, or I'm sorry, if the price goes up $1 and your delta is 0.56, it will now be worth $56 more. So usually these deltas are going to be in the ones that you will purchase likely will be in the decimal region. Some may be, whole numbers with decimals. So again, every time you see something, it's always going to be multiplied by 100. Anything that you see that has decimals, that's just what I remember. If it's decimals, you're gonna multiply by 100. Volume, okay, yeah, that does have a decimal, but it takes time to see it. But I can show you what the order looks like. So if I switch over to, I'm going to just switch over to Schwab so you can see it. Give me one moment so you can see actually.
Tyler posted a good thing that we forgot to mention. You can only sell, only buy and sell options during market hours. So you can set limits to buy and sell them in pre-market, but obviously they're not going to fill until market hours. Okay. Well, the delta theta change as days go by closer to expirations.
Yes, and I'm going to show that real quick too.
So he's switching over to Schwab, which he uses too.
It's just because I know the platform. So just so you guys know, options can only be traded 9:30 a.m. Eastern time to 4 p.m. Eastern time. Why is that? I don't know. Why is there a pre-market now? It's like I don't even know any. There's just a lot of different things. So like for some traders, they may like the pre-market or aftermarket option, or I'm sorry, the stock trading, because options are a limited window compared to stocks. So let me just also go over the one last Greek, I guess, because this delta does change per dollar. So because it doesn't just stick at 0.4. If anyone knows calculus, you've got your first derivative, your second derivative, your third derivative. You can keep on going on. I don't want to be a jerk. That's a math joke if anyone gets that, because that's a third derivative. But so the last one is gamma. So it's not Bruce Banner. It's not being exposed to anything. Oh, technically it is. But gamma is going to be the change of delta per dollar changed. So let me actually write out the math behind this. So give me one moment because I'm running out of room. So so I'm going to give out a scenario. So I bought a call for AT&T, and we're just going to keep the same one, for 0.71. And AT&T is at $28. AT&T changes to $29 the next day. What is the option price? Actually, I'm going to do 30. That's a little bit better. Okay, so here's my question, and I'm going to work this out. So we're going into math class again, all right? So I bought a call for AT&T for 0.71, so that means, $71, and AT&T is at $28. AT&T changes to $30 the next day. What is the option price? Okay, so let's look at the information we have. And let me circle. So what I'm going to look at is I'm going to look at my delta, my theta, and my gamma. So the first thing is, okay, let's look at the next day. So the first thing, and you can do these in any order, just so you guys know. But so I'm just going to look at, okay, well, how much money did I lose the next day? So I'm at 0.71. Let me get the drawing. So I'm at 0.71 minus 0.01. And this is your theta. So my option right now sits at 0.7. Okay, it went up from 28 to 29. So let's first calculate what the delta is. So 0.7 plus 0.4 is going to be 1.1. So that's going to be my delta. I'm going to put a triangle because that's what delta means. But now it hit to 30 because I said it hit to 30. So what my gamma does, what it does is it affects your delta, meaning your now delta has changed. It's going to add $16 or 16 cents to it. So my new delta is going to be 56.56. Oops. New delta. So theoretically, your option price, if you add all these together, is 166. Again, times 100. Your option is now worth $166. So again, how did I get $166? First, again, every time it goes up $1, this will affect it. Okay. Now, there is an additional Greek that affects that one, which affects that one, and another one. You know, it gets complicated. After that, it's just very minuscule. But when looking at this, you can now see what your gamma is. So if you know, okay, initially it's going to start at 0.4. Now it's or $40 per dollar goes up. But now the second it hits to $30, this delta will change. If it hits 31, okay, well, I would have to look, if the gamma was still 0.6 and this was 0.56, you would add those together. Does it work the same when it goes down? Yes. So now you know, okay, going back to 29, if this is 0.71 and this goes to 27 from my call and I paid 0.71, I know, okay, this is going to lose $40.
Yeah, but John, just think about it this way. Only pick options that are going to go up, and you never have to worry about it going down. Magic.
Yeah, and this is just the math behind how these option prices go into effect.
So Melvin asked, is that $166 an increase from the option price of 71?
No, it would be the total price. Sorry. So you made, just let's just say it's 170. So you made $100. So total price.
You profited.
So you would have, so then going back to math, how much did you profit? All right, well, how much did you pay? How much did you sell it for? Then, so if I were to simplify it, if this was 170, I subtract $71, that's your profit made. So if a dollar drops 29 to 28, the delta does drop by 0.6. Yes. So this 0.40, it will then drop. It won't be added. It's just, it goes reverse. So, or it's inverted. So it will likely go to 0.24 because if you look at the premium, it's that. But then if it keeps dropping down, there's other equations that are involved. So do you calculate this every time? Okay, so this is kind of going back to an option strategy. So if you're thinking, if you want to hold on to it for a week, I would say, a lot of traders would go right at the money, because then you can see it. It will have a higher delta, but it also has a higher theta. If you go out the money, so way out, then this won't change as much. But then again, you're not risking as much. So it kind of just goes back to car auctions. Or if you talk about sports betting, the further outlandish it can get, like can AT&T hit $33 by March 19th? Sure, yeah, that can happen. But looking at what the daily range is, if I knew AT&T went between 26 and 32, that's not a really good bet. Could it happen? Yeah. And then so if you bought this at 0.07, so 0.07 times 100 is $7. You bought a whole bunch of those, and it hits 35, then you put a small investment into a large investment.
So here's what I want to again stress. Okay, so I see Kyle said it's still very confusing. So don't worry about the Greeks, okay? Especially when you're first starting. You can if you want to. It only matters when you buy it. This is not something that you should be calculating every day. Because guess what? Your brokerage will calculate it for you. It'll tell you if you're winning or losing, okay? It'll have a percentage, and it'll either be red or green. If it's green, you're winning.
Well, he asks for an example, a concrete example. So hold on, let me.
Yeah. So really, to make it super simple, when you're looking at it and you really want to get into it, then you can look at those things when you first buy it. If it's high on Theta, then you might not want to, but just you can look at the differences. Chris will do an example.
Okay, how do I new share? Oh, perfect. Okay, Smart Edge share.
And you can use your.
Yeah, I don't mind. This is because I liquidated everything, got a Schwab, but I still had some money. So let me go into account details. So positions. So positions. Today I bought a Nokia. Let me make this larger. Sorry. I had it all filled out, but
you didn't buy Palantir, dude?
Huh? Yeah. It's just on my other account. Sorry guys, hold on. Hold on 1 second.
Now we get to see Chris's password, so you can also log into his Schwab account and play with his money.
There's nothing nothing to see here, folks.
It's free,
Yeah. Free money.
He'll be happy if you lose it all or win it all, whatever.
All that stuff, so like.
Okay, give me one moment. Where is the Zoom thing? How do I? Oh, sorry guys. I'm hitting some technical difficulties. How do I share screen again?
In the Zoom at the bottom. Share screen.
Why is it not showing up? Zoom. Oh, wait. Nope.
It should allow you to share it multiple.
Oh boy. Exit minimized. Oh, here we go. Okay, got it. Sorry. Okay. Still learning the Zoom. So, okay. So here's just a small little account. So I bought Nokia NOK. Let me make this larger. Font. Okay, so Nokia 020521, and it's a $5 call. So let's pull up Nokia.
So why did you pick that expiration date?
So this is an earnings play, and so earnings are tomorrow after market close for Nokia. And so here's my thought process. Now, this is not financial advice. All this is for entertainment purposes. But right now, Nokia is at $4.70. So I purchased this. Let me get back to my my little drawing stuff. And I'll use, because I know that's a bright color, so I'm going to use red. So, so my cost share, I paid 18 cents for it, and it's for $5. So for example, my BE, my break even point, is going to be 0.18. The 0.5 is because it added in the option price. That's what Schwab does. So plus $5. So again, my break-even point is going to be my cost, my what I paid for it, and what the strike price is. So 0.18 plus 5 is going to be $5.18. So can Nokia hit that? Yeah, it's very, very possible. So when I go back and look, so let's look at the Greeks. So this is at the 0.5. My theta is going to be 0.05. So I'm just going to keep it to a simple decimal. So my call option is going to go down $5 tomorrow. But if Nokia changes, if it goes to $5, because it bases it on the initial price of 4, so my delta, it will go up 40 cents. I'm sorry, yeah, 40 cents. I'm just rounding. So it'll go up $40. So if this keeps going up, then that means if Nokia hits $5 tomorrow, because there are what's called anticipation, or there is anticipation. So people may think, yeah, Nokia, I'm so hyped. I'm going to buy like 100 shares of Nokia. Man, I love Nokia. I love their brick phones. I love playing Snake, just whatever. Or I'll buy 10,000 shares because I'm going to, I got some money. I got the cheese. So the more hype that can happen, this will likely go up. So then let's just say Nokia killed it, like they said, like, man, like we forget 5G, we're going to 7G, even though it means generation, but we're going to 7G, it's so cool, and Nokia now hits like $10. So I can just look at this stuff. Okay, my theta, all right, so it goes down $5, but if it goes from, let's just say, $5 to $10, then roughly, what's 10 times 0.4? That would be 4. So 4 times 100. So this call option is going to be $400 more. Now, the gamma will then obviously increase because the gamma is higher for this stock or for this option because Nokia is just at $4. So if you have a stock that moves what's called, I call them ADRs, average daily range. If you have a stock that moves up and down $100, this gamma it's going to affect it, but because Nokia, it's just going to go up from $4 to $5, this gamma will likely be higher. What is the implied volatility? That is a question I'm asking myself. So look, IV is 200, roughly 200%. Why is that? Earnings reports. So you will likely see you will pay. So again, going back to the example, the lower the percentage is, the less this stock is going to move. But because people are anticipating earnings tomorrow, then this is going to be higher, meaning I paid a higher price. I got in at 18. So technically I'm up, what, $9? This is IGC, that's what it is. So what's the benefit of an option? So the benefit of an option is you can take advantage of these Greeks. I wouldn't say it's a rule, but this is just kind of a warning. The longer you hold an option to expiration date, your theta will increase because, again, if Nokia, and this is a point I didn't really cover right away, if you buy a call and it doesn't hit this price, it's worth nothing at the end of that date. So I risked $55 that Nokia will go above because I bought 3. So I risked $18 that Nokia will go above $5. Now, if Nokia just ends on the end of this week at $4.70, again, this is just common sense. A call option is the right to buy Nokia at whatever the strike price is at a certain date. So at the end of February 5th, so at 4 p.m. Eastern, that call will then be analyzed by a broker and a computer. If the strike is above what it currently is at, why would I want to use this contract option to buy it for $5 when I could just buy it for $4.70? That just doesn't make sense. So why would I want to do that? Why couldn't I just buy shares of Nokia in hopes for that? Well, if I maybe want to put a smaller stake, at that, I would rather put up $18 than buy 100 shares of Nokia, because if I had a smaller account, maybe I had a $2,000 account, would I want to put up 25% of my account to buy Nokia? So I could buy Nokia right now at $4.70. So 100 times 4.7, that's going to be $470. Do I want to expose myself to that much liability or risk? So it could be a risk management thing. So if you buy it, if you buy an option and this stock skyrockets, then you will theoretically make more money on the previous days before it expires. However, you have other things to look at. You have to look at what your theta is. So the decay, meaning how much does it lose every day. But if you want to expose, $470 and you buy it, but if it goes down, let's say it goes down to $3, so you now lost $170 compared to the $18 that you put up front. But you pay the $18 because it's a risk thing. So you're risking $18 that it could go above the price in hopes that it does. But if it goes below, then you lost the $18. Now, could you hold on to Nokia till where it hits above the $4.70? Then yeah, you could just hold on to it. But then you have money that is now not technically exposed. Well, it is exposed, but you can't invest that other money into other things that you think is that could be an opportunity. So what John is saying, he said buying shares is less risky. It's less risky, yes, because you own that part of the company. You can get the dividends on it as well. Options, you don't get that stuff. It's just you get that. Kind of just going off on, well, what happens if you hold this call option and you're past break even right at 4 p.m. Eastern? The broker will first check to make sure that you have the amount to buy the shares, the 100 shares. Some brokers, I'm not sure if they just liquidate the option. You have to check with that. They may just buy all the shares, then liquidate it, and then give you the proceeds, and then you hold the shares. That stuff, that gets really complex, so I'm not going to go into it. But simply, if you hold something and it's past your break-even point, it will then execute the call option. If you hold it till 2 p.m., meaning till market closes on the Friday, you will buy it at whatever you purchase it for. So if the call were executed at $5, 5 times 100, you would buy 100 shares of Nokia at $5. Now, if Nokia is at $6 and you hold it, then you could sell it for $100 profit. But the reason why options are becoming more popular is because you can put up lower amounts of capital to make a similar amount of money as bigger guys could do if they just buy the stocks. Because I only put in, this says 55, I know, but that's because I bought 3, so it says quantity position 3. But it's really $18 I put up, so I only risked $18 in hopes that Nokia will go past $5. Now, could I buy the shares? Sure. Could I hold on to them? Yeah, could totally do that, and then just keep holding on.
Tyler asked, if a contract expires out of the money, does it just evaporate? Yes. Okay.
Yeah, it goes away. It expires worthless. You will not see it in your account. It goes away. It's worth $0.
However, some brokerages do let you auto exercise at the end, but you have to have cash in your account to physically buy the stocks. So if you had a strike price of $15 and you do not have the $1,500 in your account that it's going to take, then no, it will not work.
Right. Yeah. And then what Tyler was saying, is it just like a sports bet ticket that didn't hit? Yeah. If it didn't hit, then it's worth nothing. You lost the bet. So you lost your $18.
How much longer do you want to keep going?
You can go as long as you want, as long as there's good questions. No, I'm kidding. Any question's good.
So we're losing people, but I mean, there's still 77, I think. Yeah, so we still have 77. Do people have more questions? If we missed the questions?
Do you guys, if you give me, if you are in an option and you want me to just look at just what we've talked about and I can explain some stuff to you, I'm more than happy to do that. You just have to tell me what the ticker symbol the expiration, and the strike.
AMD, there's a good one.
Okay, AMD, and what are you?
So I'm currently holding a nice AMD newsletter play. Woo,
Okay.
woo.
And so what date is that?
I'm going to tell you in a second. I don't know.
Or maybe because Brian asked.
Yes.
He asked AMD. So Brian, if you're holding an AMD option, can you tell me what your strike price is?
Strike price. His expiration is the 19th. Yep.
So the 19th of February?
Yep.
And what's the strike? Oh, 80? Okay. Oops. Okay, so AMD at 80. So my IV is low, so that's good, meaning that the volatility price is not going to affect it much. Here, I'll draw. My theta, so every day for right now, because it's a couple weeks out, this theta is going to slightly creep up on you the closer it gets to the 19th. So currently, and I'm just rounding upwards, you're going to lose instantly tomorrow $5. But the delta, this is what's nice, is this delta is increasing because you are in the money. Why am I in the money? Because AMD is trading at $87.89. It's an $80 call, so you're technically $9 in the money. I would say, yeah, that's a pretty good one. So the further it goes in the money, the higher your delta is going to be. Delta theoretically can only hit 1 because once it's just so past something, the way that the mathematics behind the delta, gamma, I think it's rho or zo or something, and then some other stuff. It's just it goes only to 1. So technically, every dollar AMD would go up, it would be $1. But it's since you're pretty high in there, each dollar AMD goes up, you're going to get $87 out of it. And then I know if it goes up from 87, I'm just going to round it to 88. If it goes to 89, then you're going to get another $3 added to your delta, so you'll go up $90 for that. Then once it hits 91, you just apply the same math behind it. 94 call, so that is out the money. Ooh, this stays. That's perfect. So your IV is still relatively low. However, your theta, so your decay, this is because you're way out. Okay, so this is only gonna. So tomorrow you're gonna lose about $7. However, for every dollar it gets closer to 94, you're looking at a good delta. So it's going to change to $25. Whether or not this is a good investment, I can't say. I don't follow AMD as much as I do anymore. I know they're winning the war against Intel. So this generation, I'm an Intel guy, but I know other people are not.
I'm an Intel guy now.
You mean an AMD?
Excuse me, I'm an AMD guy.
Yeah.
Current PC is Intel right now, but changing. Here's a real quick one. Somebody asked, I bought and haven't sold anything. Can you explain proper selling? So Philip, when you are ready to sell your call, it's very simple. So depending on which brokerage you have, you open up the contract itself. There'll be a button at the bottom or on the side that just says sell. The only thing you really select after that is limit. If you want to set it at a limit, you can. If you're happy with what you have, click market and just sell it right then and there. It'll autofill and you're done. There's nothing big to it. Once you do it once, you'll be like, well, that was easy. That's a very simple part. If you have questions about it, further direct message me on Facebook and I'll just show you what to click.
I'm reading through questions. To answer Philip Shaw's question, someone asked before but not answered, is learning about buying options better than learning buying shares or beginners? I would say start with shares first. That way you can see how things work. Options, I would consider an intermediate investment. If you were to tier it as new, beginner, intermediate, then advanced. I'm at 5 head. That's just a little Twitch joke if anyone gets that. But I would stick with stocks. If you don't understand what is going on, do not touch it. It's just like in the wild. If you don't know this berry, are you going to eat it? If I don't know it exactly, I don't want to eat it and get poisoned or have a trip or be fed. There's a lot of possibilities. So that's to that. So people were asking also, when do you sell? I just set a target for 30%. I'm really, really conservative. Maybe that's because I was just Schwabby. I worked at Charles Schwab as a broker. But I am conservative, and I do different stuff than what most people do in this investment group. But I'm looking through again. I bought and haven't sold anything. Can you explain proper selling? Okay, so if and again, I talked about my do nots, which would be sell to open, but you want to buy to open. So if I were to sell this call, give me a second. And again, every broker program's different, but I'm just going to click close Nokia. Mine is a little different because if you can see bid, so that is how much someone's willing to buy it for. Mid would be the midpoint between bid and ask, because generally, and I didn't really talk about midpoint because it wasn't on Webull, but your mid is kind of like, okay, let's go to an agreement. If something's between, if someone's wanting to buy it for 21, someone's asking it for, well, this says 22, but if it was 23, the mid would be 22. More times than not, it will close in the middle because they'll see the computers or another person will see that, hey, there's a bid. The bid will then change to 22, meaning someone's offering 22. It will likely fill depending on the spread. That would be the difference. But if you do bid, then it will auto sell. It'll do mark. So if you do market, it'll sell. And then you just click review order, and then click place order. Then it goes through.
Brad asked about selling calls. Brad, we're not talking about that at this time.
Okay. So from there are technically 4 types of things you can do with an option. You can buy to open, sell to open, buy to close, sell to close. So if you sell something open, you have what's called infinite risk. Just remember that. If you're selling to open, it's infinite risk. If you're buying to open, you have a finite risk, meaning you're only putting money out. When you sell to open, you receive a credit, which means you are the person that is selling the contract. So, for example, if this Nokia contract goes up to $200 per contract, someone else on the other end, whether or not it's that one person, but it's just a multitude of different people, but someone else has that bill they have to pay. Philip says, would the premium for a call a month out possibly a little less if it dipped to its low point in the day versus at the midpoint of the day? So timing is important because, again, look at the range of how the stock is trading. If you bought, for example, let me go back to Webull. Well, let's just think of it this way. If I bought the call for Nokia at for $5 and Nokia was trading at $4.80, but then Nokia was trading at $4.30, the option would be less. So timing is important. That's why tomorrow I'm going to go into charts, reading a chart, bid ask. This is because since Wednesdays have always been our time for our stream, our classroom, we covered the same topic, which is generally options. And then Jeff, just so you know, you DM'd me, not to everyone. I'm not sure if that was meant. So the premium will make an effect. The further out a call option will be, the higher the premium will be, because it's kind of like with saying, you don't have a crystal ball. If you're making a sports bet and you're saying, like, what's the Super Bowl? What's the score of the Super Bowl? In the beginning, no one really knows. But then the closer the end of the Super Bowl is going on. So again, I use Patriots versus Dallas Cowboys. If the Patriots are at 35 and the Dallas is at 14 and it's the third quarter, you kind of have an idea of who's going to win. So then that premium will be lower in regards to if you were to bet, for or against the team. What's a good average to look at to help detect movement through that stock? Ooh, that's a good question. There's just so many different theories. There's not a real definitive answer. Because some people may interpret low volume as people want to hold on to the stock as an anticipation for news, or they think that the stock will have growth. A high amount of volume could mean they want to sell it, or a high amount of volume could mean they want to buy it. It's what would be called market sentiment, which means what the market is thinking, and that's really hard to describe as well. It takes a lot of practice. It's a really, really good question. But I mean, if I were to know the answer to that, then all of us would be making a lot of money, like a lot, because we would know exactly what they're thinking. It's kind of like we can view the crystal ball, we can see the future. Excuse me. Yeah, over 10 million volume. Yeah, you can look at the chat for some people's opinions on that. So Philip goes, I had a sundial a month out at 150, paid a higher premium. I used a weekly call. Okay, yeah. So that's a good example. So looking at sundial or SNDL, so you bought. So if you look, so just kind of looking at now, sundial's trading at $1.21, so your costs aren't going to be very exorbitant compared to this, but the bid excuse me guys, for 50 cents the bid is at 65, but look, if you're out 1 month out, it's 70, or sorry, 0.7. So you're paying $70 versus 65. So I mean, financially speaking, I'm willing to put up $5 more in hopes that sundial goes. So if I'd have to figure out my break even, so 0.5 plus 0.7 is 0.12. So I may actually want to look into this tomorrow. So sundial is 1.21. So technically your break even point, this is your break even point. Look at your delta, 0.96. So if sundial, if it goes up to $3, this call right here, this is going to be worth a lot of money. However, you are paying more because look at the IV, 208. Again, this is a percentage, so you're going to pay more. The IV is increasing. Okay, and how is I calculated? Oh man, I have a math degree. I mean, I could look at, understand it kind of, but it's a lot of different stuff because it's like a formula within a formula with formula. But again, the delta is lower, so it's like, do I want to pay $35? I mean, so my break even, 1.5 plus 0.35, so that would be $1.85. I'm sorry, $1.85. So could hit that in a month? I'd have to look at the company. I know it's a marijuana company. I know marijuana is being talked about being legalized across the United States, but not on a federal level. So you have to just kind of do research. If you think like, hey, is marijuana going to be more popular in a month? What about 10 months? What about a year? So kind of just going off of the question, you can do longer. It's just the longer you go out, the more things are going to be. So let's just say if you want to buy sundial, excuse me, and you want to buy sundial right now, so you'd have to pay $121. But look at this sundial call option. This is for 2023, January 2023. So we've got roughly 2 years. Would I want to pay $90 in hopes that this will pass $2.40? This is possible. This seems more possible than a lot of the other longer calls. These are what are called leaps. It's an acronym. It's just long anticipatory something note, promissory note. But so calls past 9 months are called leaps. So this may be something to look at because sundial, it looks like it's gaining momentum. Yeah. I mean, this was at 82 cents on the 29th. So these people that are at this $1.50 or even this $1.50 ones, these are looking pretty one. Oh yeah, it is. The bid and ask are spread differently. So that also gets into investing. So what's reasonable? Do I want to pay $70 that it may hit $4 when I don't think it ever hit that? Or do I want to pay $20 more for it to hit $1.90? Or do I want to pay just $15 or $105 that it's going to hit 50 cents, which it did, but I have to think into my break-even point. So if this passes $1.55 for the stock trading, which that is possible looking at this thing. I mean, it hit $1.60 in March, sorry. Now, if it became if it became legal on a federal level, that would be a positive thing for all marijuana businesses. So if that event were to happen, I'm not saying it would happen to this stock, but I would imagine that marijuana stocks will go up. So if Sundial's still in play and or still around, and this stock could go up, it could go up to $10. Then this thing's worth a whole much more money. So Joshua asked, so if it hits that point sooner, could you close for your profit? Yes, you can. Because again, you don't know when things are going to go. If you want to hold on to it till like 2022, that's totally fine. An example is I bought Amazon calls for $18.80 back in 2016, and Amazon was trading at $300. They were very, very cheap. Amazon hit that price plus way higher in 2018, 2019. So those calls were worth a lot more money. When the bid-ask spread is really large, it's hard to fill limit orders. Yes, that's true. So if you see a large spread, I tend to not look at those because if the spread's really large, so a spread would be the distance between the bid and the ask. So if I were to look at this Sundial call option, 1.05 and 1.10, that spread is very low. What constitutes a large spread? You have to look at what the stock is trading at. So it's $1.21 right now. This is a small spread. I mean, there are options for almost for almost every stock. If they allow it, there's criteria, but there will be some with a larger spread. So let's just say Tesla. So look at the spread for here for 870. Let me highlight it. So look at this spread, 339.20. That means this call option is $33,000, $33,920. This bid and this spread, 345. So people are asking to sell this for $34,515. The mid is here. I would say this is a large spread because we're dealing with whole numbers, meaning the spread is roughly $600. So it's whatever you're comfortable with. Do you want to buy a Tesla call that's going to expire on January 20th, 2023? Do I want to pay $33,000 for it? Hey, there are people that will do that. What is bid size? Bid size, so again, it's what you're asking to pay for it. The ask is what people are willing to sell it for. Change would mean, Tyler's question, what's the change referring to in these calls? Does the 0.12 for the 50 cent mean that the premium just went up $12 today? Yes. If that's what it was at, I'd have to look. So so that means this call option went up $12. So if it's negative, it'll be red. And then Philip, if you want to DM me on Facebook, you're more than welcome to for practice, because if you want to think. So I guess to end it, let's talk about realism. And this is more of like how I would look at things. Going back to AT&T, because some people may be like, well, like what is reasonable? So let's think of this. It's February 3rd, 2021, and this call options is February 5th. AT&T right now is trading at, again, $28.51. Do I want to buy a call for $38? No. Would AT&T want to hit? Do you think AT&T will hit $10 more by Friday? Since AT&T, the highest I've seen it hit 38, but it hasn't hit 38 since April. This was when the pandemic started happening. So would it be reasonable to think I'm going to buy a call for $38? No, that does not sound reasonable. Am I saying you can't do it? You can do whatever you want. If for whatever reason they say, hey, we discovered aliens, we're using our technology and only we can decipher it, then I mean you made the jackpot because you spent $1 and now you've got, and let's just say this spikes up to like AT&T hits like $500 or something, then you're like, whoa, I just won the jackpot. Now would that happen? No. Well, could it happen? Yes. Will you think it will happen? Probably not. So okay. I'm not going to go over. This is Steven's question. He asked some more advanced strategies. Iron condor, butterfly. That stuff we have another guy that can explain that stuff. Those are spreads. I can go over them, but I'm not going to go over them on this call.
Yeah.
Or I'd probably go over those with very few people that have all the knowledge learned here, plus like maybe 3 or 4 months, meaning every week I'm going over something. You're basically, this call is kind of like we're learning intermediate algebra. Tomorrow will be beginning algebra. You're asking maybe 4 or 5 levels above. Maybe three levels. Okay. Very interested in learning. Yeah. One step at a time. If you don't understand the options, buy a stock. That just buy 10 shares. I can't. I don't know what your risk management is. If you just want to buy one, that's fine. If you want to buy 100, sure. That's totally up to you. But again, it's not advice. This is just for entertainment. But if you don't understand it, I would highly recommend do not get engaged.
Yeah.
Even if you ask like, hey, does this sound good? And I say, hey, this sounds good. But if you don't understand it, I wouldn't do that. It does come down to common sense too. Like could AT&T, so AT&T is at 28.51. Now I'm looking at the daily chart. Now, could it hit $29 by Friday? That's very possible. If the market rallies, yeah, this could hit 29.
Quick
but
question.
I'm not saying, oh yeah, go for it.
When you sell it, are you selling at an ask price or setting the share price?
Oh, you're going to sell it at the option price. So I would look at the ask. I generally try and fill at midpoint because I know it will sell. It's kind of like gentleman's agreement. You shake hands, you go in between. You can wait because if the stock goes up, then this bid will go up. The midpoint will go up. The ask will then go up. So you can set limit orders. You can set stop limits. You can set a lot of different stuff. And I will go into tomorrow buying and selling just a stock and talk about the bid ask, the spread, what a chart is. I'll likely go over tomorrow just going into buying something, reading a chart so you can understand what it means. That way you can make a better decision on your investments. Just looking through. Strangles. I'll answer your question. The same with Strangle. That's an advanced option strategy. So if you buy a Strangle on the week in the beginning, so it's basically you buy a call and a put, and in hopes of one of them hitting past the direction. But then that's a spread. That's more of an advanced strategy. But to answer Steven's question, Strangle. I always think of Strangles because, that's a straddle. I'm getting confused. Strangle would be if you sell the calls because you're choked. Because if you're strangled, I know it sounds bad, but if you're strangled, you can't breathe. So you're looking for a small. It has to hit in the middle of something. Straddle is where you buy. Anyways, I'm going off, Connor.
Yeah.
I'm catching myself.
So we have a guy that is going to teach a class at some point, probably in the next month, about option strategies like straddles and other things like that. He's specialized on that. Okay, I think I'm going to call it quits, and I record it. So just because we're already an hour and a half.
Okay.
Is there anything else that people need to get out? Or if you don't, message one of us, Chris Haven on Facebook, Connor O'Brien on Facebook. If you have a question, post it in the group. if you have the question, somebody else in the group probably has the same question. So kill two birds with one stone, get your question answered, and somebody else can get it answered for them as well. Yeah, it looks like we might have to get a bigger Zoom room. So
Okay.
we might set up a Patreon so people can donate to us for that. But newsletter subscriptions, like the YouTube, please. We love you, all of you guys. So beginners class is tomorrow. So we're doing basic trading basics tomorrow at 6 p.m.
Yes. Yeah. So I haven't really locked in the whole curriculum for the basic, because right now we're doing more Q&A stuff, because now that the group's getting larger. Before, I was doing a pretty solid curriculum. But Thursdays we've opened up. They, because I'm part of PersonaFi. What my title is, I have no idea. Just call me the professor if you want. but tomorrow I'll be going to very basics. Kind of what is a chart, looking at a chart, what's a candlestick? Because like right here, you just see like a bunch of lines going everywhere. What does this even mean? I have no idea. But I was going to explain all that stuff to you so you can understand. That way, if you use a broker that, when you look at your broker and you look at stuff, you can then have a better understanding of what's going on. So I like Walter's comment. The professor has my title, PersonaFi. Yeah, I'm the professor of PersonaFi.
PersonaFi professor.
Yeah.
All right, guys.
So, cool. All right. Well, thank you. Yeah, and then just make sure you join us tomorrow. I'll go into a little bit more depth of some other stuff, and then we're planning also to do technical analysis. We'll probably touch that briefly, maybe tomorrow or next week.
Yep.
So, yep. Just like Batman, same time, same place, same channel. So again, thank you guys. Have a good night and
Look
happy
at that
trading.
hat. Wow. See ya.
Oh, that's really cool. All right. Good night, guys.
Super excited. Bye, guys. Thank you.
Thanks.